What's good, everyone, and welcome back to our Financial Forward channel. We're on our free money glitch series number 1, talking about the final part of fundamental analysis, bottom up versus top down analysis part 1. We will look at methods used by financial analysts around the world to help identify the best investment opportunities, and we'll learn how to apply the top down analysis approach and look at an example in this lesson. So grab your notebooks, buckle up, hands and feet inside the rod at all times. Let's go glitch this money. So many investors start an analysis process by looking at individual companies that they're interested in and making decisions on based on current share prices and what they perceive as value. The method that works best for each investor is dependent on their investment goals and experience. And the top-down and bottom-up methods provide analysts and investors with a lot of information to base investment decisions on, okay? So with the top-down analysis, investing using a top-down analysis approach focuses on the bigger picture, also referred to as the widest lens, to help understand the state of the economy and different market sectors as part of the share selection process. Far more emphasis is placed on the state of the economy and market trends than on individual shares, which generally makes the turnover of investments more frequent. Okay, this process is generally carried out in 3 stages. So you have the economic analysis, the sector analysis, and individual company analysis, which we covered probably a couple modules ago. So top-down analysis brings them all together to help an investor make the most informed decisions based on information derived from all 3 stages, right? Passive investors with long-term views on market performance and expectations can benefit from top-down analysis. So we begin with global and economic analysis. So the first stage involves investors looking at macroeconomics to assess the state of the broader economy. Macroeconomics is a division of economics that focuses on large-scale data like global and country-specific GDP, the federal funds rate, inflation rates, those types of data. From this info, an investor is trying to identify where the global economy is placed in the economic cycle in order to choose sectors that will perform better in the current climate. Okay. Once the global economy's position in the cycle is established, we can then focus on the state of the domestic economy. Understanding the domestic economy position relative to the global economy is an important part of the analysis process, and it includes research in the key areas of GDP, interest rates, inflation rates, and unemployment rates. So unlike most of the world's major economies, some countries didn't slip into an official recession in terms of GDP numbers during the global financial crisis, right? This information throughout the early stages of the GFC probably would have given a lot of investors valuable information about the material sector and how it remained high for nearly 9 months from the very start of the global financial crisis. So then there's the sector-specific analysis, which is the second stage, and it involves analyzing the 11 market sectors we talked about before. The current market positioning on the economic cycle affects the performance of the sectors. So now that an investor knows where the current market is, the next step is to identify the sectors which are expected to do well, right? There are multiple sectors that are expected to perform better at different stages of the economy cycle or the economic cycle. And we can identify and compare sectors with similar expectations to find the best investment opportunities, okay? Sector-specific analysis is carried out by using some of the fundamental metrics explained earlier in stage 1, with the addition of technical analysis to help identify potential trends and or weaknesses between comparable sectors. In series 2, we'll talk about technical analysis, so don't worry about that right now. Now, the final stage of the top-down analysis approach is identifying opportunities in specific companies, right? We can narrow our research down for individual shares if we know which sectors are expected to perform well in the current climate. The fundamental metrics we looked at before were the PE ratios, BP ratios, PS ratios, debt to equity ratios. We can get a good idea of how the company outlook fares against its peers if we compare it to these similar companies in the same sector. So by following the top-down analysis process, we have the benefit of selecting shares that belong to sectors that are expected to perform better than the broader market and put ourselves at a distinct advantage as, we're investing in line with the, so to speak, ebb and flow of the economic cycle. Okay. So let's apply the process to an example to demonstrate what a top-down analysis approach would look like. So let's assume that an investor is looking to build a new portfolio with an investment window of 5 to 7 years, all right, which is typical. Our investor's name is Shanene, right? And Shanene wants to capture the best growth opportunities for the next 7 years, even though she is not concerned with diversification for its portfolio because it only makes up a small portion of her financial investments. So Shanene first looks at the global outlook by researching the GDP, the inflation rate, federal funds rate, and the major economies' unemployment numbers using global and economic analysis, right? Shanene finds that global GDP levels have fallen for 4 of the last 6 quarters, right? Unemployment rates on the rise in Australia, Asia, and right through, the major centers in Europe. And although inflation rates have remained steady for the last 2 quarters, the federal funds rate has fallen to a record low with a future cut forecast in the next quarter, right? Now, the U.S. economy has the same low interest rates as other large world economies. The U.S.'s GDP has fallen in line with the global decline for 5 of the last 6 quarters, with the exception of the most recent, which was unchanged, and the inflation rate has flatlined. Shanene notices that the unemployment rate in the U.S. has recently gone down. Okay. The new housing starts numbers have increased for the last 2 months, and consumer spending figures have increased slightly from the previous month. So now Shanene thinks that the market is either in a contraction or a trough phase of the economic cycle. All right. Shanene has shifts her focus to domestic market sectors, right, where she finds information that backs up her thoughts about where the market currently stands on the economic cycle, right? The financial sector was the most notable below average performer for the past year, according to her, who compared the recent performance of domestic market sector. So Shanene finds that the financial and utility sectors had the biggest deviation in performance, and decides to put the 2 sectors onto a chart. Okay, the financial sectors have stopped moving lower, and the utility sector has started to move up at the same time. The speed of the move on the S&P 500 has slowed, and most recently has started to move sideways, as shown by Shanene's chart on both sectors. The world's economy has been in contraction, but there are signs that the domestic market could be in a trough phase. Okay, Shanene can now use this research to focus on sectors that have historically performed better in the trough phase of an economic cycle, right? The financials and consumer discretionary sectors have been identified by Shanae as the ones most likely to perform better in a trough phase than the better market or the broader market. Shanae only wants to invest in Australia's largest companies, right? So she narrows down her research to only companies that are in the top 20. Okay. Shanae then compares the companies in the sector to each other and to the sector itself for clues as to which company may be overvalued. Okay. So after looking at the data, Shanae decides that the company that seemed to be undervalued was company ANZ. Okay. So one, ANZ has a lower PE ratio than the other major markets, or the other major banks, should I say. A low PE ratio indicates that the share price has fallen while company earnings may have remained relatively unchanged. As we have already learned, though, share prices can fall for a variety of reasons that don't directly relate to the individual company, and thus, in these circumstances, the company could maintain steady earnings, right? Number two, ANZ has a lower BP ratio than the other major banks, right? A lower BP ratio suggests that it may be undervalued as ANZ's market price is trading closer to its asset value than the other banks, right? This could act as a safety net if the broader market decreased in value, as the other banks may fall, because the other banks may fall quicker and further in price. Number three, AMZ has a lower PS ratio than the other major banks, which indicates that investors are willing to pay less per dollar of sales per share than for its competitors. This suggests that the company may be undervalued, right? High BP ratios often indicate that a company is overvalued. Remember, okay? And then number four, AMZ has the smallest DE ratio of the major banks, which indicates that it may have more borrowing capacity in the future, right? This also suggests that it can withstand further weakness in the broader market, making it a less risky proposition. Okay, so Shanae decides that she will buy ANZ to represent the financial sector, and she also decides that she wants representation in the consumer discretionary sector. So she also purchases West Farmers, as you can see on the chart, and this is the sector's only company representing the top 20, right? And so for the video's sake, this is not real data, right? Real data wasn't used in this case study, and there's no way we recommend a share purchase here. But it does highlight how important this analysis approach is, okay? This process gives us all a good chance of success, right? As it did with Shanae, right? And she's potentially buying a sector's most undervalued company, right? This sector is expected to perform better than the broader market because it is at the right place of the economic cycle. So we're going to pause here for now. The free money glitch fundamental analysis on bottom up versus top down analysis continues in part 2. Like, comment, and subscribe. I love y'all. From yours truly, Financial Forward.